So you want to learn about reverse mortgages and how they work. As a mortgage broker, I've helped many families learn about the actual pros and cons of a reverse mortgage, without the spin and misinformation from the gurus and others seen on YouTube. I've even helped my own family with a reverse mortgage. I originated the reverse mortgage from my own mother before she died a few years ago, and it was a game changer for her. So I've been on both sides of the table, as a reverse mortgage professional and the heir of a reverse mortgage borrower. In today's video, I'm going to go over the major points about reverse mortgages and how they work so seniors and their families can be better educated about how a reverse mortgage works and how it may or may not be the right move for you. Now, I am certainly no Tom Selleck, but I do know my mom loved Tom Selleck when I was growing up. So I'll do my best, okay? So let's get into it. What is a reverse mortgage? Quite simply, a reverse mortgage is any loan secured by real estate where repayment of that loan is deferred to a later date, usually when the home sells. The flow of money and the loan balance is in reverse. On a traditional or forward mortgage, you start with a large balance, make payments, and your balance goes down. You pay the servicer. With a reverse mortgage, you start with a smaller balance, you're not required to make payments, and your balance goes up. The loan servicer pays you. There are multiple types of reverse mortgages in the marketplace, but the FHA insured HECM or home equity conversion mortgage accounts for the vast majority of reverse mortgages done in the United States. It's the only reverse mortgage insured by the federal government, and because of this, it offers the best terms. The federal government agency that insures the HECM is HUD, or Housing and Urban Development, which of course is the regulatory agency for Federal Housing Administration, or FHA. So this video will examine the HECM FHA product. Also in this video, we're going to be talking about the traditional reverse mortgage refinance where you're already a homeowner and plan to stay in your home. You can also buy a home with a reverse mortgage, and it's a phenomenal way for seniors to buy real estate. But that's a subject for another video. Okay, so what are the requirements for a reverse mortgage? To be eligible for a HECM reverse mortgage, you need to be 62 or older, attend HUD-approved counseling, either over the phone or in person. Afterwards, your counseling certificate is good for 180 days. It must be your primary residence and eligible for FHA financing, so it must conform to FHA property requirements. You also must continue to live in the home as your primary residence. You must have substantial equity in your home to allow for the reverse mortgage minus existing liens and closing costs. How much equity you need depends on your age, your home's value, the state you live in, the current rates, and the type of HECM and distribution chosen. Now, you're required to pay your property taxes and insurance and HOA dues, otherwise known as your property charges. This requirement is no different than if you have a forward mortgage or if you choose to live without a mortgage. These expenses are always required, guys. It is not a unique feature of a reverse mortgage that these expenses must be paid. This is a common reason why many of the gurus cite as a negative about reverse mortgages. Look, we all know the government is going to get their money, and you need insurance against hazards. Especially here in Florida, guys, with hurricanes and everything else we got going on. So if you live in an HOA, you're required to pay those fees. Next, you're required to pass a financial assessment. And that reviews your credit, your income sources, your assets, and your residual income to make sure you can pay for the previously mentioned property expenses. This requirement started in 2015 to ensure that seniors have the cash flow to pay the property expenses to lessen the odds of a foreclosure for failing to pay them. The financial assessment is also a major benefit of the reverse mortgage, in my opinion. It really highlights a key difference in the qualification standards between forward and reverse mortgages. To qualify for a reverse mortgage, you must pass a residual income qualification standard versus a forward mortgage or normal HELOC loan debt to income standard of around 50% maximum. Residual income is essentially income minus expenses and then comparing that number to HUD's requirements. For instance, a family of two here in Florida needs $886 a month in residual income, which is a figure most clients can make. Talking with my senior clients day to day, I see a common avatar profile. Seniors who have paid off mortgages all their lives have great credit scores and many times significant assets. However, their income drops significantly and they can't qualify for much due to the debt to income standard that forward mortgages use, or the ability to repay standard. A reverse mortgage opens up more options, which is always a good thing. Okay, the next tip is how will I receive my cash? With a reverse mortgage, you can receive your cash in several different ways. You can take a lump sum, you can receive systematic payments, you can have a line of credit that grows over the years, and a reverse mortgage credit line works much differently than a normal HELOC, or you can do a combination of these. Most of my clients elect to take a lump sum, then have that growing credit line for future needs. It's a great way to plan. How much cash overall you can receive, depends on the HECM type chosen, the appraised value of your home, the age of the youngest borrower, the state you live in, and your current mortgage debts you are paying off. Now, before I move on to the next tip, a little about me. My name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, Florida. I'm a licensed loan professional originating mortgage loans for families each and every day, and not just a Tom Selleck-like spokesperson. If you could do me a favor and go ahead and smash that like button to help YouTube algorithm know to distribute videos like this to other viewers like you who want to learn more about mortgages and real estate topics. And don't forget to hit that subscribe button as well. I very much appreciate it. Also, if you want a more in-depth discussion of reverse mortgages and the loan process, then make sure you click on the link in my description and the comment section below. Because I have a free guide that will dive deeper about reverse mortgages and how they work. This guide will walk you through more of the process and benefits of a reverse mortgage in an easy-to-read PDF format. You can review in your research and you can share with anyone you wish. Again, make sure you click the link in my description box and the comment section below. Now with that out of the way, let's move on to the next tip about reverse mortgages. Who is a reverse mortgage for? In Dan Helmquist's book, Understanding Reverse, it's a great book, linked in the description, the 3 categories of reverse mortgage borrowers who benefit the most, and I agree with them as a mortgage professional from what I see in practice. Number 1 is need. A reverse mortgage for those with an immediate need. I've had many clients that needed money now for various reasons, such as to take care of a sick loved one, house repairs, medical bills, renovations, etc. So that's the immediate need. The next is lifestyle. Since reverse mortgages don't require a monthly payment, it can greatly increase your monthly cash flow. Add in a line of credit that grows over the years, or receiving systematic payments, and you can have a drastic swing in your cash flow. You can have the freedom to travel, home upgrades, and other things that you wanted with this increased cash flow can help pay for. Number 3 is your financial plan. I have many financial planning professionals that refer me clients that may benefit from a reverse mortgage. These clients might not want to access their investments for their monthly expenses, especially if they're newly retired and that money has to last the rest of their retirement, or if it's in a deferred retirement account with tax consequences. Now, I've seen some statistics that nearly 90% of the net worth of seniors is in their home equity, and seniors over 62 are sitting on $12 trillion in home equity. So using a reverse mortgage to access this equity is a strategic use of home equity assets combined with the overall financial plan that they have with their financial advisors. Who is a reverse mortgage not for? I believe a reverse mortgage can be a suitable loan for many seniors, and they should do their due diligence on them with their families. However, there are some instances, in my opinion, where a reverse mortgage is not a good option, such as if you don't plan to stay there long term. This loan is best if you know the home you live in is your forever home, or you wish to age in place, as they call it. If you plan on moving soon, then a reverse might not be a good option. Number 2, if there is little benefit. Sometimes you may qualify for just enough to eliminate your monthly mortgage payment, which may not be a great long-term benefit if you have a lot of debt or you take on a lot more debt after the reverse mortgage. So those are some of the categories where it's not for those folks. Okay, what happens to the house when the last borrower dies? A reverse mortgage is a non-recourse loan, which means the FHA guarantees that neither the borrower nor their heirs will owe more than their home is worth at the time it is sold. That's a great benefit, but how does it happen? FHA mortgage insurance premiums are collected along with interest each month. And this pot of funds helps to insure all HECM borrowers if this happens. So it's a universal fund that the government maintains. So what are the options for the heirs after they die? And like I said earlier, my mother had a reverse mortgage that we've helped her with, so I've seen these choices firsthand. The choices depend on if the heirs want to keep the home and if there's equity left. Here's a chart again from Dan Helmquist's book, Understanding Reverse. So if there's equity left and the heirs don't want to keep the home, they will sell the home, and the proceeds will be distributed as part of the estate, which is what happened with us. If there's equity left and one of the heirs wants to keep it and live in the home, they would need to pay it off or refinance into their name. If there's no equity and they want to keep the home, the heirs can refinance at 95% of the home's current value, which is the non-recourse feature. Lastly, if there is no equity left and they don't want the home, you can do a deed in lieu of foreclosure and walk away. Now at this point in the video, you might be wondering about more other videos on the channel, so YouTube wants you to watch this video right here.